Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. And it's important to get some of the smartest fund managers on the street to try and assess how is it that they are approaching the current scenario, not just for the immediate near term, but for what promises to be a fairly volatile and choppy rest of the year as well. Mrinal Singh, CEO and CIO at InCred AMC, joins in right now to talk about his thoughts. Mrinal, great having you. Thank you so much for speaking to us today.
Thanks, Neeraj. Thanks for getting me over.
And the pleasure is ours. Mrinal, actually, can I start out with maybe one piece of good news, if you will? I think the markets love political stability, continuity, and if anything, the exit polls, they're not the results as yet, but the exit polls do suggest that there is political stability and continuity in the state that mattered the most in the five. You reckon the markets will look at that slightly positively, or that doesn't matter too much in the larger scheme of things currently?
Yeah, well, so that would have mattered, but there are bigger things that the market is kind of worried about. So, particularly the war in the Eastern Europe side and the evolving scenario on a lot of things that are fluid between the Western allies and the way things going on with Russia, energy prices, commodity prices. I think that's weighing on the market more than the election outcome. Election outcome largely seems to be in line with expectation, no surprises. For most people, I would say. So I guess that would pass on, and market will continue to worry or care about the other things.
Yeah, safe summation. I'm just glad that we didn't have one more thing to worry about, to be honest. But yeah, let's talk about the bigger issue. How do you approach a situation like this, which is difficult to comprehend as to what could happen? Because I don't think you can attach a hypothesis to a potential outcome, both in terms of the timelines or in terms of an impact, simply because there is a humanitarian impact and what could happen to various themes, etc. But also the fact that it is causing an upheaval in the way commodities are behaving.
Yeah, that's very true, Neeraj. And what is clearly got the market worried. Even before we walked into this situation, inflation was kind of a worry thing for the market. The central bankers and the market investors had started talking about it in a meaningful way. Well, a war is never a good thing. There are no winners in a war, frankly. I mean, it is a humanitarian catastrophe and man-made about that. So there will all be efforts made to make sure that it settles amicably with least of humanitarian losses. But then, the geography that it is, it has a significant impact on energy prices. Russia in particular is a very large supplier of energy globally, very, very critical to Europe in particular. So I guess, the energy prices shooting up and they continue to be very, very jittery, the consumers and the traders around it. So that's got the world worried and rightly so. We've had so many situations in the past where all kinds of economic issues have emanated from oil going here and there. Be it the first oil shock or the second oil shock, and even wars around the Middle East, which have had an impact. See, crude particularly has been always a geopolitical commodity, frankly. I mean, it has always been very, very highly influenced with geopolitical outcomes. But then, having said all that, I don't think the current prices of crude are, sustainable because the economies globally can't absorb that. It impacts consumption. It impacts overall pickup of those commodities as well. So I guess it will. The worst scenario from a perspective of these prices would be, that it will slow down growth. Maybe in some cases where the growth was already fragile, drag it into a negative territory. But then the good part is, for an economy like ours, clearly because investment is the driver of growth, we might be better cushioned from this. We do get severely impacted by rising food prices, no doubt about it. But then I am assuming that that is not going to sustain for too long. In the meanwhile, it will be painful, no doubt.
Yeah, so that's the question actually. Tactically, I mean, the Credit Suisse note today also says that tactically, because of oil, they are moving India to an underweight position purely because of this fund. So And and it's curious that how some people, officials from the Russian side, are saying that if they stop the gas supplies via Nord Stream 1, and if oil supplies are under question mark because of the West ban, which US seems to have reached some agreement for, then oil prices could reach 300. I shudder to think what could happen to the Indian finances if oil were indeed to reach, forget 300, but even another $30-40 per barrel here, from higher from here on.
Yeah, so our oil consumption is anything between 1.25 billion barrel to 1.5, somewhere in that zone. So every $10 movement in oil kind of impacts us by roughly 12.5 to $15 billion. But then see, the markets obviously will respond negatively to price hikes of commodities from here. But I think that would be very interesting for investor like ours. Okay. It gives us very, very interesting entry prices for businesses where we think will ride through this. The clear emphasis would be domestically oriented businesses, businesses which are going to benefit out of investment into our economy. I think consumption is a segment that gets severely impacted by higher prices. The base metal prices do impact the investment theme per se, but then I would say, on that side, we are a little better placed. Naturally, we have a good amount of ores and a lot of cement, particularly, is a local commodity. There are no global prices for it. So, I hope the war in Eastern Europe also doesn't last too long. Interestingly, the sanctions are also very tricky in nature. I mean, Europe is not saying they will stop consuming the Russian energy. US is talking about, although there are sanctions on payment systems, so it's a bit weird, how it's progressing. It's still fluid. Let's just admit it is fluid. It's not drifting in the right direction. But then downtick in prices for long-term investors like us, if there were businesses which we were liking and the prices were just on the higher side, I think that's getting into a zone which would envisage our investment interest. And we are quite upbeat about interesting prices. We would look to allocate our clients' money significantly over the next 2-3 months in this volatility. And I think that's going to be very, very rewarding. We've seen that in the past. Worse scenarios have happened, frankly. I would say Corona was a much worse scenario than this. This is a man-made scenario. Corona was something that was completely out of control. I would say this is definitely something that in wise minds and times should pass by. I would allocate towards listed equities in a wise way into areas particularly which are domestically oriented. Capex in particular, investment, infrastructure, mortgage, housing, I think they have a long runway.
Okay, let me try and play the devil's advocate, Mrinal. A couple of questions to this. One, there is a fear that at best, Europe hits stagflation. And if the worst turns out to be true, they might dip into a recessionary zone. Now, Europe is not front and center of everything that India does, or for that matter, what the world does per se. Still, if a large continent like that has those issues and some of the others also face some growth issues, how does it impact Indian growth, if you will?
So, valid point. EU and US in terms of the size of economy are roughly the same. 20 odd trillion, give or take some. So they are the largest economic blocks on earth. The third one being China. So, well, a recession in any part of Europe or even US, or even lack of growth or stagflation, I'm trying to avoid taking those words, but would definitely have an incremental impact on demand emanating from those places. Now, that's exactly why I say, even if I take that to be true partially for some time, our domestic investments into the economy, I think that continues. That momentum will continue. Okay. I would not profess and say that stagflation is on the anvil. I don't think so. There could be inflation, but has there been a significant higher chance of that compared to any time in the last 2-3 years? The answer is yes. I hope things don't drift in that direction. But then higher inflation and next to none growth, something is I would say the pace of growth is such, and the central bankers would like to taper down prices in a way that doesn't impact growth. But then our investments, domestically oriented businesses or capex investments or housing momentum. I think that has more to do with domestic demand. And I think we are amongst the few economies globally where even the global analysts, be it the IMF or Moody's, are talking about an acceleration in growth. That is clearly a good sign.
The only question that I'll have to that, Mrinal, is that under normal circumstances, India's investment in Capex, government-driven Capex with the finances that were likely to have been in place would have been a no-brainer of sorts. Does this situation alter that simply because growth itself will get impacted, revenues might get impacted, and most certainly the commodity cost pressures impact the government finances in a big way, particularly oil, but the others as well. So does the much hoped for Capex story driven largely from the government side in the next 12 months and then maybe private following that get delayed a bit more?
So, taking that point ahead, I think the three drivers of investment in the economy or Capex in the economy, the government, the private corporate sector, and the households, I think the most significantly impacted by current scenario would be government, because crude dents their balance sheet. They might be able to provide some cushion by reducing the taxes that they have on the petroleum products, but that will still impact the revenue a little, I guess. So I think they are the most vulnerable. Their Capex outlook might become back-ended a bit. Let's say the Union budget mentioned 7.5 lakh crores of Capex guidance. I think that might become back-ended if they start seeing pressure on revenues. The private Capex, I've seen the momentum when it picks up. It does take some time for even it to solve. Let's say last time when we saw the momentum of Capex in 2003 to 10, even after the demand shock of 2008, it took 2-3 years for that momentum of Capex to halt. And the starting point that we have now is far better balance sheets. I get comfort that the current energy prices are not sustainable. So the momentum will drive that private sector Capex beyond the elevated price that we see currently. The household Capex is a function of income outlook. And I think the private Capex has a significant impact on the income outlook. It's also important to note that, although the state elections are behind, the general election is ahead. We have some state elections even later part of this year. The general observation during such time zones is that even the government is basically in such times continues to spend, particularly on the rural side. So government fisc might come under strain, but their Capex commitment might continue. Okay. So I draw comfort from historical precedences of such nature in the past, where I think the domestic Capex outlook will for some time remain good, unless we see prolonged elevated energy prices, which I don't think are economically viable.
Okay, so net, Mrinal, just before we get to equities first, full lock, stock, barrel for the next 5-7 minutes, is your hypothesis that even if there is a slippage in or rather a miss of the glide path, if you will, that the government has embarked upon and clearly articulated, reiterated in the budget, I would say, you would believe that the Capex story will stay buoyant simply because of wanting to push growth as well as political compulsion. So it may, because the revenues of the government are certainly under pressure, more so now that it seems to be that even the LIC IPO might not be the prudent thing to do in the current turbulent times any which ways.
So interestingly, the observation of such phases in the past has been the government delays payments rather than stop spending. So, okay. They will, because the policymakers do realize that continuing to spend is very important for the economy to be revived. We've seen enough of such phases in the past. The payments get delayed, the spendings don't actually.
Okay, that's an interesting point. Okay, so I believe you are coming out with a product as well, which is right in the thick of those themes, right? Capex oriented and not focused necessarily on the large caps and mid caps. It's an interesting time to launch it. Does it tie in with what you believe will make the most money over the course of the next couple of years? Tell us a bit about that and tell us a bit about your equity investing hypothesis, Mrinal.
Yeah, so very clearly, I think the most interesting space for classical investors would be small cap and mid cap as of now. Large caps are obviously very well researched, and there is more than abundant data available around it. It requires a different skill set to make significant alpha over there. Information arbitrages don't work largely, but then you require different skill sets which are also available even at our end. But we see the turns that the market is seeing. I think the economy is moving from a consumption mode to an investment mode, which is what we recognize, and this is where we draw comfort and confidence that that is going to be the drivers of flag bearers of growth going ahead, irrespective of the current macro scenario that we are seeing. The interest rate outlook is expected to be a bit stiffer, but then where it is now was anyway not sustainable. And it is far more comfortable in the context of India than the West. I would say that it's amongst the most conducive environments to borrow and invest to create capacity. We've rarely had all the three drivers of investment in the economy, be it the government, be it the private sector, or be it the households, in that mode that we see now. The private sector and the banks included have very spick and span balance sheet now. We've come out of a very large time zone of consolidation. We see the government doing quite well on the revenues, although the energy prices do cause a question mark over there. But then, as I mentioned, once the budget is granted, I think the spending part is something that government, it takes a lot for government to stop over there. They tend to cut corners otherwise, but generally tend to continue. And in any case, even if they have to extend a fist to do capex in the economy, it is not viewed negative. It is never viewed because investment, if you do subsidy for increasing fist, that is where people kind of get worried, but not for capex. And the households, as I hope the job generation data as it improves, we'll see a very large demand from the household side. We have a very young country. The demographics are very favorable. There is although we talk about a lot of negatives regarding the commodity prices, what we tend to miss is, we are coming out of a corona zone wherein, things are normalizing. The economic activity is opening up. What a lot of people call, the recovery trade or the corona opening up trade. A lot of businesses which were kind of stuck are back to business. Schools are opening up. So we are normalizing human life. We are also going to have that impact on the general economic conditions. So, well, interestingly, the demand has actually already, larger part of demand parameters are already pre-COVID levels. It is only going to move up. Had not it been for these dampener in terms of spiking commodity prices of late, I think it could have been even significantly up. But I would still say the trajectory is up. The larger driver of inflation, in my view, is not liquidity. A lot of people assume that it is the global liquidity which is causing inflation. I think it is the supply. Even now, when we talk about food prices jumping, it is the supply-related issues which is making it jump.
Sure.
What if the Russian supply is out of the system? So the only way to deal with supply shortages is actually create more capacity.
Sure.
So that is a driver of capex, and we will see significant monies have already been committed, and they generally don't get withdrawn midways.
So embedded in your thesis is also the belief that commodity prices by and large will not stay elevated, because otherwise the margins of some of these capex plays will be torn to shreds any which ways.
Yeah, so they will come down, they'll cool down from here, and to what extent we'll need to see. That
of course, and therefore, Mrinal, I would presume that you guys are not amongst those which are buying into the commodity-linked businesses, because there is a play being made out there from the sell side as well. A lot of people are pretty constructive on metals, even on energy. You are not quite there, I presume.
So not at this juncture.
Not at this juncture. Okay. So you played that theme already, you're saying.
Yeah, I would say the other side now which is getting battered is getting into a zone which is interesting.
I get your point. Okay. My final couple of questions, Mrinal. One is, what about I know you mentioned that you are looking at domestic themes, but there is a bit of belief that non-commodity linked themes, which might also be global in nature, IT, for example, might be really safe bets, and the valuation multiples might not deviate as much. and there is a bit of an earnings certainty out there. What are your thoughts here?
So excellent businesses, IT. We've never seen in the last 25 years a scenario what we see now. Our IT exports are able to largely fund our energy imports. This has never happened. So this is a prowess of human capital that India has created. So I guess, and that it's not going to be easy to displace that, but it is still dependent upon the growth in the English-speaking world largely. Both sides of Atlantics. So their association with that growth is far higher. I think it is well recognized. Elevated multiples actually show that it is growing quite well. We see a very interesting, and that might do well. So we are not denying that. But we see interesting pockets of manufacturing, particularly Capex oriented household, housing and stuff, building material, where we see, the investor attention is lacking and a lot of action is happening in that space. So we prefer that compared to this. That's all that's how I would put it.
Very good. Mrinal, one final question to you before we let you go. I was thinking of asking you between banks and autos. I'll choose the latter, and ask you what are your thoughts there. Simply because a lot of presentations, a lot of belief around how 2022 could see the revival of autos from an investing perspective. But there's also issues around semiconductor shortages, which might only get exaggerated because of what's happening in Russia and Ukraine, and neon and palladium, etc., etc. Are you constructive? Are you sitting on the sidelines, or are you negative on autos?
So, well, I think autos are very interesting. And I would say between the two names you took, I would prefer mortgage, corporate lenders, and auto ancillaries in that sequence. That would be a very, very interesting place for me.
Fair call. Okay, Mrinal, firstly, we wish you all the best with the new product launch that you're doing. So do well there. And thank you for taking the time out and speaking to us today and giving us some sense of how you guys are thinking about the current juncture.
Thank you very much, Niraj. The pleasure is all ours. Thank you so much.
Lovely having you, viewers. Thanks for tuning into this edition of the Talking Point.